When we compare and contrast the performance of the second quarter with respect to the markets versus the first quarter, we would have described the first quarter as a broadening out in terms of performance, whereas the second quarter we've seen more of a divergence between contributions to equity market performance, between central bank policies and the direction for interest rates, and a divergence in the economic data that was released during the quarter. Equity market performance in the second quarter was quite different than the first quarter. In the first quarter of the year, we saw a broadening out of market performance, whereas in the second quarter it was fairly narrow. Narrow in the sense that the larger component to performance in the United States for the S&P 500 came out of the tech sector or companies related to AI in general. And this supported the S&P 500 to a positive return in the quarter, as well as driving the NASDAQ to a return of near 10%. In contrast, we saw the Dow Jones Industrial Average modestly negative, as well as international equity markets and in Canada, the TSX. This reflects the broad divergence that we've seen in terms of performance and the narrowness of equity market contribution to performance really being centered around that tech sector in the United States. When we look at the fixed income markets, here too we've seen drivers of divergence. That is, divergence by central bank policy. In Canada and in Europe, the Bank of Canada as well as the European Central Bank chose to cut their respective policy rates by 25 basis points in the quarter, while signaling further interest rate cuts to follow through the remainder of 2024 and into 2025. This is very much different than what we saw in the United States, where the Federal Reserve maintained its policy rate and not yet signaling cuts are forthcoming for 2024. The bond markets responded, however, by pushing yields lower during the quarter, pushing up the prices of bonds. Now, this not only was a reaction to the central bank policy signals, but also to some of the economic data that came through in the quarter that was softer than expected. When we look ahead through the remainder of 2024 and into 2025, we're using the phrase position, don't predict. Don't try to predict the outcomes of the market through the remainder of this year. Rather, position for the potential outcomes. A well-balanced portfolio will be better suited to take advantage of any market opportunities.